Welcome to our channel. If you're a returning viewer, welcome back. Nice to see you again. And if you're new here, please show us support by giving us a like and subscribing to our channel. We highly appreciate that. Thank you so much. Now, without further ado, let's get into the video. Today we are going to go through some of the basic rules of investing. We are going to name 8 rules that you can follow, but also please take note that this is just a suggestion and that real investing should probably be carried out with the help of a financial advisor. Every situation or financial situation is different, and individuals should always carry out advice from certified financial advisors. Now that we got that out of the way, let's jump into the 8 advice or rules of investing. Start investing as early as possible. The rule of interest on interest is what, combined with years of investment, can make a significant difference in the amount you invest and the amount you will be able to enjoy one day. In practice, you should invest as soon as you receive your first salary. Even if you didn't jump on the train in time, it's still not too late. However, then things should be viewed in a time horizon that is much shorter than the 40 or so years you have at your disposal when you are relatively young. So, don't hesitate anymore. Start with small amounts and increase the stakes over time. Saving is a prerequisite for investment. To be able to invest at all, you have to save regularly. The exception is made by those who inherited property, but I believe that there are still a few of them for any meaningful comment. Saving often requires living below one's means, but that is for all of us the only prerequisite for creating a surplus for investing. However, just saving is not enough. Inflation devalues money, and therefore it is necessary to invest it. And investing means buying assets that have the potential to generate a reasonable return. Invest only in what you understand. Be aware of the potential earnings, but also the risk that investing in certain assets carries. In short, this would mean understanding how an investment can bring profit, what historical returns are, and what losses can result. Do not take the advice of friends or acquaintances if you don't understand how this specified property works. Take the effort and study, and only then invest. If you are inclined to make very risky investments, approach them with smaller stakes. That is, with money that you can afford to lose permanently. Understand the level of risk you can handle. We all have different levels of risk we are willing to accept. Copying the strategy of others is not an option, especially when it comes to investors of different ages and situations. 10,000 euros can be play money for someone, and lifelong savings for someone else. Also, younger people can afford to invest to a greater extent risky assets, such as shares, given the long time horizon in which they have time to recover from market falls that inevitably occur. The older you are, part of the funds should be invested in less risky assets, which necessarily bring lower earnings, but also a lower chance of losing the investment. Expect realistic returns on your investments. In the long term, annual returns of 5 to 10% before inflation can be achieved on asset classes such as, for example, stocks. Some asset classes can bring higher returns. The question is, how long term? But then we are also talking about a higher risk that should not be ignored. Be realistic in your expectations and don't take risks you can't handle. Always look at the returns in real terms, that is, net of the inflation rate. Think long term. Investments in proprietary instruments such as shares, real estate, own business carry a certain risk, and therefore it is necessary to have a long-term perspective when investing in them. In practice, this means a minimum of 5 years and ideally 10 or more. Some will say that is too long, but these are my rules anyway. Match the time frame of the investment with the need for money. Take care of when you will need the money. If you need them within a year or two, then you invest them in liquid instruments, such as time deposits and the like. The interest is zero, but at least you won't have to sell at times when the market may be extremely unfavorable. Take care that you have to keep a part of the assets liquid, easily convertible into money, and in most cases these are amounts at the level of 3 to 6 months of living expenses, which guarantee that you will not have to sell other assets at the most unfavorable moment. Diversify your investments. Diversification is a key concept in investing. In short, it means how you should hold different investment classes, stocks, bonds, real estate, gold, etc. in your portfolio. It is ideal when these investments have a low correlation, so while one asset falls in value, the other grows or is at least stable. Diversification should also be done within the same investment class. For example, investing in stocks from different geographical areas, different currencies, and the like. Take care of your overall financial situation. Before investing, check your overall financial situation, state of debts, pension savings, and insurance. Investing in debt repayment is one of those with the most secure returns. In that case, the return is equal to the interest you pay. Therefore, before you start investing in stocks, gold, and the like, make sure you have no debts, except for a real estate loan where the interest rate is significantly lower than what you can get on the capital market. And these were our tips on investing, but here are a few extra tips that you can also use before you start making your first investment. Ignore short-term changes in the market. The following financial news for entertainment, not for investment advice. Also, you should definitely ignore short-term movements in the value of assets in the portfolio. Take care of asset allocation. Asset allocation is a key prerequisite for smart investing. In short, it defines the investment ratios in different assets that best suit your investor profile. Take care of taxation. Don't ignore the issue of taxes because it can significantly affect your return. That was today's video. Thank you so much for watching, and I hope you enjoyed it and that you learned something interesting. Make sure to comment down below if you have any of these traits and what of these traits describes you the best. To show us support, please give us a like and subscribe to our channel for more similar content. And I will see you in the next video.